Hey, good morning options traders, and happy Thursday everyone. And I just wanted to do almost an impromptu video here on a little walkthrough on the Analyze tab in Thinkorswim. And it's because we got a good question from one of the traders in the group yesterday asking about the difference between today's curve, what's also called the current curve, and the expiration graph in a profit and loss diagram. And her question was, why would we be concerned with the current curve if we're not, at least in most cases, going to be exercising a call option early? Well, those are two completely different situations. The decision to exercise a call option early comes down to a tug of war between the size of the dividend and the option's time value, and technically even the interest rate, but in today's zero interest rate world, you can forget about that component, at least for now. But we'd still like to know the value of our option at different stock prices and at different points in time. So to help answer a question, why is that? And how can we use a profit and loss diagram to make better decisions? So let's go over to Thinkorswim and take a look at the Analyze tab. So over in Thinkorswim, you can get to the Analyze tab by clicking this one right here. And you've got some sub-tabs here. You can choose a simulated trade. You've got your risk profile, which is the graph that we're on now, probability analysis, which is a similar tool, but I'm just going to focus on the risk profile. Now also in the Thinkorswim training classes, I do extremely thorough walkthroughs, every single tab, sub-tab, drop-down menu that you would want to see in here. This isn't meant to be a real thorough view of the Analyze tab, but instead just to give you an idea of why we would want to look at the current curve. So let's go over to simulated trades, and of course you could put in a real trade as well. And I'm just going to choose, I've got vertical spreads listed here, so we'll use a vertical spread. Notice that Microsoft closed at 212.94, so let's call it about 213. So let's just say we wanted to do the 210-215 vertical spread. Now one little trick that I use in Thinkorswim, rather than trying to get different pairings of strikes over here, because to do that, it's a little convoluted. You have to come down here to deep and wide, 1 month by 3 strikes, 4 strikes, vertical, and then click it. So what I do is I don't care which default that I'm in, I just pick one. So let's say that we want, we'll do the August 20s with 15 days. I'm going to just click on the asking price as a buy. And I can change the expiration dates from down here as well, but I can also change the strikes. So I just change it from down here. So unless there's a reason you need to see the entire quote board in the pairings, I just choose it from here. We're going to do 5 contracts. Of course, we could change that. And to make the diagram easier to read, I'm going to just make this $2 flat. So in other words, we're contemplating sending this order at a limit of 2, and if we get filled, what will our various profits and losses look like? And to do that, we're going to swing over here to the risk profile. So I can first off change the scale. I can click on the stock prices here. I can zoom in. I can also, it's easier if you just go out here to the sides, and I can also zoom out. Okay, so kind of get the scale that you want. Then you can click in your chart and actually drag the chart. So very quick, very easy to maneuver around. So as always with your profit and loss diagrams, we've got our stock prices on the horizontal. We have our various profits and losses for this position. In other words, 5 contracts purchased at 2. But we're also looking at 2 different points in time. The blue curve, this is one you usually see in the books and the websites when they're talking about strategies. This is the expiration graph. And the only time you're going to look at this one for answers is when you're almost at the closing bell on expiration day. But if you want to know what's going to happen today, you need to look at this pink curve. This is the current curve or today's curve. And they both show you the same idea in that they are giving you your resulting profits or losses at various stock prices, but they're doing it at 2 different points in time. All right, so let's take a look at how it might work. Notice that when I move my mouse across the graph, see that white line that's moving? That's my mouse cursor right there. and I can line it up at a stock price down below. So let's line it up down here at about let's see if we can get exactly 215 right there. Okay, so you see right there is 215. And what that's telling me is that if the stock, Microsoft, hits 215 today, I look right here at this white number, 367.62. I would be expected to have a profit on these 5 contracts of $367.62. Keep in mind, that is not saying that's the total value of the spread. That's my profit after selling it. That's why it's called a profit and loss diagram. Of course, this isn't what you're guaranteed to get because that depends on implied volatilities and skews that could occur throughout the day. This is just a pricing model, but you'd be surprised at how accurate they are. In most cases, that's going to get you really close. But if I wanted to know what's going to happen at expiration, I would need to read it off of the blue curve. So how can I do that? We'll look down over here to the left, and it gives us another scale. It shows us today's date, 8/6 of 2020. There's your 366.99 for the, now pointing to 214.99 for a stock price. But you notice that the blue curve is showing the expiration date, 8/22/20. We would be up almost $1,500, $1,497.17. But I would need the time to pass all the way to 8/22. So the stock price could sit dead still right here at roughly 215, but if I hold it all the way to expiration, that profit's going to grow from 365 to almost 1,500. And if we look back over here, that's the difference between this purple curve and this blue. All right, so this purple curve is slowly going to start moving towards the blue, upwards over here. And on the left-hand side, it's going to start moving down. I'll show you how you can do that also in Thinkorswim. But let's also take a look at these little red hash marks. This red hash mark that intersects the purple is the break-even for today. So I would need this stock to be right there at about 209.20, right there, roughly 209.21 to break even. At expiration, I would need it to be at about almost 212, right there, 212 to break even at expiration. So another thing you can see from the graphs, you see the distance between these red hash marks? That tells me that my break-even point is going to start getting further and further away as time passes. All things being equal, at least for the call options, we'd like to see our break-evens shifted left because those are lower stock prices, much more likely to happen. So the way that we read this graph is very simple. We're just going to slide along and we can ask various questions. So for instance, let's say that I put this position on and my goal is to get a $500 profit. How would I solve the problem? Well, just look at this white number right here until it becomes 500. And I don't need to get exact, but somewhere in there, I look straight down below. Let's call it 217. I know I need the stock price to be at 217 today to make a $500 profit on this position. And then I can kind of analyze if I think that's realistic or not. If I needed to make a $1,000 profit, or that was my goal, I'd have to come way out here. Actually, I have to slide way out here to the right. You can see you'd have to be at about, right about 226. So that would be kind of really highly unlikely. But it gives you some good insights. So what else can we do? Well, these are the various profits and losses today, but what if I wanted to know what it's going to look like tomorrow? Do I need to wait for tomorrow and then get caught with some kind of a big surprise in the way these graphs change? No, I can change that down here where it says date. Today's date is 8/6, and I can choose this plus sign. So I'm going to go to 8/7. Now you probably didn't notice, but that purple line moved just a tiny bit. So watch what happens. I'm going to click through faster here. Watch the purple line, and as I click, it's showing you how that profit and loss is going to change and eventually collapse right onto the blue. Okay, so this is the day before expiration. You can see what a big difference there is in one day. The stock is right here. One day later, that profit goes, watch this, all the way to the top. See, that's good information. But you wouldn't know it without looking at the current curve. So for the most part, the expiration graph in blue does very little good. You can do those in your head. If you have the $100 call and the stock is at 108 at expiration, you know it's worth 8. I don't need an expiration graph to tell me that. I know if it's below the strike, it's out of the money, it's worthless. It's easy to figure option prices at expiration. That doesn't necessarily mean that this blue graph is completely worthless. It does tell you the ultimate ranges of where your profits and losses could go, but the real important one is the pink one, the current curve. Now, also in thinkorswim, as kind of a side note, you can come up here and do various looks. What if we wanted to see how our deltas were going to change? Choose that. Here's your delta curve today, and here it is at expiration. So where will my deltas be maximized? Right here. When the stock is basically dead center between those strikes. I can see how it's going to fall off or how quickly it will fall off today. Or if the stock price rises, how quickly my deltas will fall off. What about my gamma curve? I could look there. That's how my gammas are going to behave. Where's my maximum positive gamma? Well, if you know your option theory, it would be right at the strike of the long. Long options have positive gamma. Where's the maximum negative gamma? Strike of the short. If long options have positive gamma, short options have negative gamma. But at least I can see how it's going to change today. If I want to see how it's going to change at various points in time, let's go back to today. That's how my gamma curve looks today. How will it look tomorrow? Look at that. See, I can see how it's going to change. So this is why it's so important to understand the current curve. This is really where all of your decisions lie and where all of the important information lies. It really has nothing to do with whether you're going to exercise your call option or not. Now there's one final thing to understand in thinkorswim. It gives you some handy information. If you see these vertical, look like goalposts here, these are called price slices. And I can put various ones on down here by choosing this plus sign. I can also right mouse click in here and do an add slice. And there's a lot of really neat things we can do with these. But for starters, what you can do is line them up at various points on your graph. And if you look up here, I've divided my chart into thirds. Everything to the left of this gold one, everything between them, and then all of the area to the right. And thinkorswim is showing you what's the probability that the stock price will be somewhere here to the left. Right there, about 38%. What's the probability that it's somewhere between these two gold price slices? About 22%. The probability that it's above? Almost 40%. So I might want to line up my price slices, let's say at my strikes on my vertical spread, and say what's the probability that I'm not really into maximum loss, but I'm somewhere between these strikes. Got about a 19% chance that I'm going to be somewhere between my strikes. I've got about a 40% chance I'll be at maximum gain, and I've got about the same 41% chance that I'll be at maximum loss. So again, that's some very handy information. Now we can also look at this little gray area back here, and this is giving us a pricing models look at where the stock price could go, based at the 68% level of confidence. So I can say that between today and 8/17, this is where the stock's price will most likely go at 68% confidence. So notice that as I add more time to the clock, there's more chances for the price to drift. All right, so then if I change my clock here, you'll see the gray area shrink because we now have less time to expiration. So not only do you get a look at how your profits and losses will fare, but you also get a look at the probabilities at various stages of your graph. So I hope that helps you to at least understand why you might want to look at the current curve. But as always, if you have other questions, feel free to post them. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab, as well as a complete training course in thinkorswim. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.